Thank you very much for joining me this lovely Thursday afternoon, depending on what part of the country you're in. I understand it's raining up north, and we have a beautiful day beautiful autumn day down here in Melbourne today. So, and also thank you for taking time out on a very short week. I don't know how most of you are feeling, but I think trying to fit 5 days into 3 is very exhausting, and I'm looking forward to another long weekend, I must admit. But anyway, we'll get into today. So today I wanted to spend a little bit of time talking about Tax Administration 3.0 and give you a bit of an insight into, I guess, my thoughts on it, where I think it potentially is going to be an issue for us, and in what you all may need to think about when dealing with clients in distress with 3.0 heading your way. Before I do that, just a little bit of an update on what's been happening in the insolvency framework and what's going on around the place. March was the largest individual month of insolvency appointments in the last 10 odd years. So we had something like 1,447 first appointments made in the month of March. So a very, very big month, certainly showing the rise that is starting to come back in. However, you will see it drop off again in April. So it's quite regular in terms of the way the pattern works, that April is often a quieter month. Obviously, we have all these holidays tied together, not that Easter is always at the exact same spot, but it does seem to every year, looking at the stats, have a drop in April. But certainly we're seeing an increase. But what's interesting in the increase is that there hasn't been necessarily a matching increase in court appointment insolvencies and wind-up applications. So there's certainly a lot of activity in that space, but the growth that we're seeing at the moment is coming more from the activity of the ATO and others, because we're certainly seeing a lot of other creditors, private creditors, going after their money as well, forcing directors to make some decisions and put their companies into liquidation. The other big thing for those who who did come along to our in-person seminars last month, you would have seen we talked a lot about the increase in activity around SBRs. Now, for those who weren't there, the current trends are showing in the vicinity of 25% of all insolvencies in Australia are currently going through the SBR system. And when you consider outside of SBRs, the way that the data is produced, there's about 10 separate different types of insolvency. So for one of those to be 25% of the market is an incredibly big number. And again, for those who were at the seminar, I apologise, but I'll just quickly run through it again. Although I and all of us here at Jonge actually think the SBR is a good measure and has its place, I think one of the big problems with it is because it's got the name small business in it, everyone is assuming it's the best thing to do for a business. That's not true. The reality is that the SBRs, I think, will cause us a lot of problems in the coming months, and particularly in the next 12 months. Because of the way that people are overusing it, because it's an easy thing to sell. Unfortunately, as I say, just because it's got the name small business in it doesn't make it that it is the right thing to do. It has been popular in part because the ATO has been very, very supportive of it. But that is changing. That support seems to be changing, particularly in the last few weeks. Through some of our connections, we've had some discussions. There's been some discussions with the ATO around how they're now viewing SBRs compared to what they were even 2 months ago. And I just wanted to highlight a couple of things, because I know a number of you, whether by choice or by circumstance, are referring some clients directly to SBR practitioners And we're now dealing with some of the impact of that when those clients come back to us afterwards with proposals that haven't worked, or with proposals that the clients can't afford to maintain. And now we're seeing quite a bit of work in the space of actually getting people out of SBRs. But some of the things that the ATO have highlighted as now being reasons why they won't support it, or if they do support it, they're going to support it at a much higher cents in the dollar return. There's a lot of stuff in the marketplace at the moment that you'll talk that the average is around 25 to 27 cents in the dollar. And our experience would certainly correlate with that in the past. What they're doing now, however, is that they're really starting to ramp up. And if you don't meet a myriad of requirements, they're requiring much higher numbers for them to now consider it. So some of the things that I want you to consider when you're talking to clients about it, if you're talking to them, they've got a really bad view on directors' loans. So in the past, if you had a director's loan in the company account of, let's say, $100,000, the ATO would want to see an offer being made of more than the $100,000, which was pretty easy to navigate. So if you knew it was 100, you could put an offer in of 120, and then they would feel as though that's at least that money's coming back in, and they were happy with that. What they're saying now is that we want the 100,000 repaid, and then we need an offer of another $120,000. Because when you do the maths on it, if the director's taken out 100,000 that he owes to the company and he makes an offer of 120, he's really only adding another $20,000 to the pot than what the company already had. So the ATO's attitude has changed quite considerably around that loan account. We've certainly had circumstances where the loan account was more than the tax debt. So we were recommending against using the SBR because we couldn't match that up. Now it's even more so the case that if you've got directors' loans, we've got to have a strategy to get that repaid, as well as putting up a reasonable offer. So when you're looking at clients and their accounts and potentially talking about SBRs, the loan account is certainly something that you want to have a good look at. The other one of the other things that the ATO have said is that they're really against being the only creditor. Now there's again, a lot of people, when you see the advertising out there, is do you want to reduce the ATO's debt by 75% or something like that? And we particularly have also seen clients are going, well, I don't want to upset my suppliers, so I want them all paid so they're not part of this process, and I'm just dealing with the ATO. Now, 12 months ago, again, the ATO didn't make too much noise about it, but they're now saying that they're unlikely to support an SBR where they are the only creditor, and particularly if they can see that some of the other creditors have been sorted out and looked after just prior to the SBR being appointed. So now where it's been billed as a good tool for negotiating with the ATO only, I would now suggest that may not be the case quite as easily. One of the other red flags for the ATO now is that they're talking about if they've issued notices on the company, whether it be serious notices like garnishes or DPNs, or if it's a number of the red letters and credit bureau reporting, any of those things have done, and the taxpayer has not engaged with them prior to appointing an SBR, they will see that in a very dim light and with a very red flag as something not to support. And some of those discussions that we have had with the ATO office in trying to put a plan up for people is that we found that they're wanting sort of 80 cents in the dollar, 90 cents in the dollar when there's that type of behaviour has been existed. It's probably no secret that the other thing that they're annoyed about is lodgement issues. Again, we're seeing a lot of businesses trying to clean up their books the day before that they appoint an SBR. So they might fix up their SGC the day before. They might lodge a couple of extra BASs that were behind the day before. If you're lodging just before as part of a cleanup process, then I'd highly recommend you take time between those lodgements and when you appoint, because they're seeing that as a very big red flag. The other thing that the ATO has highlighted, the two last things I wanted to mention on this front, one is that if there is a bad compliance history, there's almost a penalty that you put in the penalty box, and any offer you make must be substantially higher than what it would otherwise have needed to be if you had better compliance. So they're wanting to see, I guess, using my words, they're putting you in the penalty box and making you pay a higher price to get any benefit out of it. The other one, which is an interesting one, which we haven't, I can't say I've seen them talk about in any of the different forms of insolvency, is that they're really looking at the total related party structure. And if it would appear as if you've got 2 or 3 companies in the group, one of them's been put through an SBR, but the other 2 look clean, they have a concern now, and they're flagging a concern that why are you actually looking after 2 and letting this one go? So there's a change in attitude around structure now that if one of them's in problem and all the others look clean, they're seeing that as a red flag that you're probably planning a structure around getting the benefit of the ATOs. So I think I've spoken about it a number of times on this webinar and in other forums that I think the SBR is a very good tool. However, it's because of its overuse now, like anything, something that's too good to be true often is, and we're now starting to see it come back to a more reality checked space within the marketplace of what will and won't be used. So again, not against using it. I think it's an incredible tool, and particularly with the debtor in possession model as it exists today, it being the only way of doing it, I think it is the right tool for the right business. And it's also the right tool for a lot of people who have licenses. So some of you, I know, were on the webinar when we had QBCC on a couple of months ago. The only way a builder can get through and keep their license in Queensland is using insolvency is with an SBR, because it's not part of their legislation at the moment. And because it's a smaller debt, the QBCC seem to be comfortable to use it. So there are occasions when you need to use it. But when talking with your clients, or if you're hearing clients that have been out talking to other people about it, just be a little bit aware that it's not the easy solution that it was maybe 6 months ago. And that's catching a lot of people unawares at the moment. We've got Jonge's got 4 in at the moment, and the conversations that we're having to have with the ATO to push it through are a lot more intense and got a lot more detail in it than they were even 6 months ago. So where it was a really easy, you just did it and it happened, that's no longer the case. So please keep that in mind when you're talking to your clients. I was saying this morning that we're in a slightly different world these days, where a director who might be having some trouble can jump online and go, what can I do about my tax debt? And if you do even a search like that, you probably get the top 15 SBR advertisements saying, we can solve your problem, we can solve your problem. So we've got a lot of directors coming to us uninformed, talking about the SBR being the only solution. And, I think, as I said in the webinar, we've probably got about 4 or 5 matters at the moment where we are actually helping directors get out of their SBR agreement. So they went into it because they were sold the pup that it was the good thing to do. The payment arrangement was not affordable for them, and now they're in just as much trouble a couple of months down the track, and they're now asking for a more appropriate insolvency strategy to give them a chance to move forward. So please be aware that it may not be the absolute answer to everything that we think that a lot of people are trying to make it out to be. That's probably it on the insolvency front at the moment. There's always bits and pieces, and I'm going to talk through a little bit around some of their collection activities as I jump into this tax administration 3.0. So jumping into that, a lot of you would have heard it talked about, this tax administration 3.0. I'm going to just call it 3.0 from now on. Because there's way too many long words for this black duck on a Thursday afternoon. So 3.0 has the concept of this new theory has been around quite a while, and it's actually gone through iterations of 1.0, 2.0, and 3.0 has been talked about. The difference is that we're now starting to see some of the implementation of the concepts of 3.0. So for those who haven't heard about it, and there probably still quite a lot because it's really more of a concept thing than a reality thing in a lot of ways. If you look at the big picture of what's trying to be achieved by 3.0, or what the North Star is, I guess, of where the ATO is wanting to take this administration and modernisation of tax compliance, is that they would like to get to a point where reporting, payment, and then real-time compliance happen instantly at the same time. So not you're thinking about at the moment, if we talk about BASs, we lodge the BAS, a separate in the thing is the making of the payment, and then there is the compliance audit component of it. So what they're trying to do is to get to a point where those taxable events coincide at the same time. That's as I say, the North Star of where they're trying to get it overall. Now, that's a big picture thing, and that's something that's they're talking about through to 2030. It's not stuff that's going to happen tomorrow automatically. But if I give you an example of one where it's already starting to come into play, particularly in other countries, we would have all heard about e-invoicing. There's been a lot of talk around e-invoicing. The real concept of e-invoicing is that I would raise an invoice in my system, and like when you transfer money in the bank, you press a button and that invoice is electronically sent to the other end, and it's automatically uploaded into their system. So it's going from one system directly into another system. You're not printing an invoice. You're not PDFing that invoice. You're not emailing it or putting it through the snail mail. It's literally just press a button and it electronically will pop up in the other company's system. They will then, obviously, it gets processed into their accounts payable and they work out when they're going to pay it. That's the true concept of what e-invoicing is. There's no data entry. There's a lot less chance of fraud. There's a lot of things that work for that an advantage. And interestingly, in doing the research for talking about today, there are already 40 countries and other tax jurisdictions that have implemented this true e-invoicing. Now, we're not there yet here in Australia. They're talking about getting there, but we haven't arrived at that point yet. The protocols and the systems and the way that this will all be put together in Australia is actually being controlled by the ATO. So the ATO have the oversight of managing how the system is developed. Again, I don't pretend to be an expert in how the technology will work at this point, but if you assume it's similar to the banking, it comes out of one bank account and flows through to another. It's going through a system where the third parties are all connected. The ATO has control over the development and design and protocols around that. And so they're working towards that coming into play. when we look at it from a small business point of view, and when we think about where that's going to go, is once you get into electronic invoicing, the ATO is going to have a very specific knowledge of exactly every dollar that's being transferred between companies. And that's part of what this 3.0 is to try and get to the point where it's all electronically done and can be data matched instantly. So there's already, as I say, 40 tax jurisdictions which are using this e-invoicing system. We're probably not too far away from it. And Phil's just reminded me, for those who don't know these sessions, if you've got something to add or say or a question, please feel free to put it in the chat box and we'll work our way through. We use Go Cardless currently, which automatically bills the client. They do, and also do the accounting entries in our system. So good point. So that's one side of it. So automatically billing it is still being done. When they automatically bill it, they're still sending it out as an invoice, I understand, Phil. What this system will actually do is, rather than sending an invoice, it'll send a little technology stuff, and it will actually create it straight into their system. So it'll actually go straight in as accounts payable, rather than sending the invoice and then someone having to upload it. The two systems will talk independently of you doing anything with it. So we are certainly getting closer to it on a daily basis. So it's certainly building in that direction. So that's one part of the of what they're trying to achieve as part of the 3.0. Extending that digital integration, what they're trying to achieve is, if you think about it from the business activity statement point of view, when you think about it from the business activity statement point of view, GST will be covered by e-invoicing. So once that technology is in place, that will be able to effectively tell you exactly what's going on the GST front of every business. We've already got, with PAYG, we've got the STP software in place. So the ATO have been made aware of PAYG and Super almost instantly. Now, it doesn't include the payment component yet, which is another part of the integration, but at least that part's being reported. And what they're also trying to do as part of this data integration is for PAYGI, a lot of letters in that, but for the installment component, what they're trying to do is to create the software that will go into every accounting system that will look at what the business is doing for that quarter, and then determine the installment that's necessary on that quarter. As you would all know, for those of you who have to deal with installments at the moment, your installment rate for your income tax for the future year is determined by last year's tax return. So if you had a $100,000 profit, they might say that you need to have installment percentage of 10% for the next year, and each quarter you've got to pay your 10% through. What they're trying to move to as part of this data integration is that they'll actually move that your accounting system and will report, this is going to be a good quarter, so therefore the installment should be this. This is going to be a bad quarter, so your installment will be Y. So when you think about business activity statements and this move to data integration, they have the ability to move from us having to self-report GST, PAYG and PAYGI to not having to report it at all. It will be automatic. Now, how far away that is, I have no clue. And to Phil's point, I have no idea, but I've no doubt the security protocols will have to be immense, like anything to do with any of the digital age. And they do make comments. They do make comments in some of the data about how far the ATO is needing to integrate cybersecurity into everything they do now. Because I think one article I read said that every month on average they get something like 2.5 million attacks. And in the heart of the tax season, it actually goes up to 3.5 million in tax. So why you want to attack the accounting system, the tax system is another thing. But the significant cyber attacks that they're already dealing with on a daily basis. Phil, the reason why none of this is in place yet is that there are a million questions. How do you realise unrealised profits and losses? Right? Not my space. I'm up here. I'm just talking at the really top level up in the clouds. Someone else who's a lot smarter than me will work out some of those details over time and probably get them wrong if we all know the way it works. Why I wanted to, well, apart from it just being a topical conversation, apart from it all being a topical conversation, one of the other things I wanted to raise about that I think we're moving down this path quicker than we want. How fast that happens. Again, they're talking about this by 2030, which is only 5 years away. Whether it gets there or not is a whole different issue. One of the things that I want you to be aware of early is that when you start doing this, you change the reporting model. And if you think at it at the small business level and compare it to what some of the big businesses are already having to do. So for those of you who deal with large remitters, so large PAYG remitters or large employers, you would know that every week or every month that they pay their wages, they need to pay their PAYG directly to the ATO that week or that month. That's deemed to be the reporting of the PAYG. Now, I have had the privilege, honour, had to help deal with a client who was a large remitter who got themselves into a fair bit of trouble. The problem that they had is that when you look at lockdown or non-lockdown director penalty notices, everything is based on when it's reported. If there's no longer a need to report because the system does it, that potentially leaves all of us as small businesses and all of our clients as small businesses exposed the minute the report is done electronically. So if we still have a client who's struggling to pay their bill and it's being reported automatically, then all of a sudden you're actually creating this lockdown liability issue at the director's level. Now, why I bring that up is twofold. One is it's even though it's not in yet today, it's not something that we need to worry about today for this new technology stuff. But over the years, anyone who's known me would know that I talk about the corporate veil and how that corporate veil is being slowly eroded, transaction by transaction, by every move that's being made. Is that we're finding the corporate veil and the separation of structure and individual is being eroded away. So if we know that we're heading to a path where directors are going to be more openly attacked or have the ability to be more openly attacked, now is a really good time for us to be considering what asset protection things that we can put in place for clients that might take 3 or 5 years to enact. Say, for instance, we want to move a house from a husband and wife's name to just the husband's name as the wife is the director. Trying to swap the sexism around today. So to move it into the husband's name, the wife's got to buy, or the husband's got to buy the wife's share. And that can take time for that sale to process through because that comes with money. So having time to restructure to allow for better asset protection is potentially a really good thing that we can consider. And next month, we're going to talk a lot more about that in the lead up to a lot of you needing to do your annual reviews with clients. I'm going to talk, we're going to go through some of the things that you can look at as part of that annual review process. So although I think it's really exciting that technology will take away some of these issues, potentially long term, we're talking about if you bring those 3 taxable events together, reporting, payment, and the checking off of it, there'll come a point that insolvency of this nature is going to be much harder to do, because if payments are occurring at the exact same time, our small businesses won't be able to use the ATO as the bank and use it to manage their cash flow. Now, that obviously has ramifications, because I think all of you would know clients that the 10% GST and the 25% PAYG that they're withholding is being used to prop their businesses up at the moment. Right or wrong, I'm not going to get into that philosophy. Right or wrong, that's happening today. And if some of these things come into play, businesses will be in trouble overnight. So planning ahead and looking at 3 to 5 years ahead can be very, very handy thing to do. So that's the real in the cloud stuff in terms about where they're trying to take things. I think it's something that we probably need to be a little bit more aware of. Obviously, with STP, that's taken a while to introduce, but it's coming into play at all levels now. So it's certainly having a more significant impact, and it's the first of the three arms, really, when we look at it from the business activity statement point of view. The next one I wanted to talk about, which is still part of this 3.0, and this is the transition of and I guess it leads into what we're talking about long term, about having this cash flow being dealt with at the time of the taxable event, is that you would have seen a lot of advertising around the ATO talking about moving small businesses from quarterly BASs to monthly BASs. Now, the promotion of the activity has been focused around creating better reportable habits and creating better tax compliance, because it's happening monthly. Supposedly, the only businesses that are meant to be getting this letter somewhere in the next 6 months. It started from 1 April, by the way, and we have already heard of businesses being converted. But what supposedly the only businesses that are meant to be moved from quarterly to monthly are those who have not been good at their compliance history. So they're late in paying, or they're part paying their BASs when they lodge them. They're late in lodging full stop, or they're not lodging at all. So any of these companies, smaller companies that are on quarterly, if they're not being compliant on all fronts of their tax, they are likely at some point to get a letter to convert to monthly. Now, again, from a cash flow point of view, there's a lot of argument for smaller businesses to operate under a monthly BAS, but I know in years gone by, very rarely would I ever recommend quarterly. Not that I have to do a lot of recommending of it. I wouldn't recommend monthly, because you now have 12 chances of being late. So, which means that you have 12 chances of getting fines. You also have 12 chances, there's more opportunity for activity statements to become lockdown. I'll give you an example. If we look at the current quarter that all of you are probably madly doing BASs for your clients at the moment, January to March quarter, finishes obviously the 31st of March. Without the benefit of your tax agent, they normally have to lodge by the 28th. So next Monday, Tuesday, next week. I know some of you get another 3-week extensions and different things like that, but put that aside for this example. If I lodge that document late after the 28th, I've got one chance for a fine. But if I do lodge it late, I've got till the end of July before any lodgement of that BAS would create a lockdown direct penalty notice. If I move to monthly, my January BAS will become into lockdown phase about now, at the end of April, 3 months after it was due date. February happens in May. And then, so all of a sudden, your PAYG, your GST can all become locked down much quicker under this system. And if you've already got a client who's not great at paying, not great at lodging, and now we're going to ask them to do it more regularly than they're already terrible at doing, you're actually opening up the door for a lot more problems for these clients. I understand the concept. If we've all, if you've got a BAS after a quarter, you've got to pay 150 grand. It's probably easier for a small business to find 50 grand every month than it is to find 150. But if they're in trouble, if they're not doing all the right things, we've already got an issue, and now we're going to make this issue even bigger. So I just want to highlight it because I would imagine all of you will get a letter of that kind for one of your clients at some point in the next couple of months. And there's more to it that you need to consider than just, hey, you need to come in here regularly. There's obviously also the cash implications of businesses that rely on getting big chunks of cash to be able to pay their bill at the end of a quarter. Now, if they've got to pay monthly, that's a little bit different. So Phil likes chatting, which is great. Thank you, Phil. Do want cash basis or accrual basis for accounting. Surely this is to do with cash flow. Look, I don't know that the ATO think it's to do with cash flow per se, if that's what you're asking, Phil. I don't think they really look in the bank account and go, oh, we need a little bit more money. What they're worried about is the fact that we've still got somewhere between, depending on which press release you read, somewhere between 30 and 50 billion outstanding on small business debt. What they're trying to do is to get small businesses to start paying it. So if they make it smaller numbers, maybe they think that they're going to get better numbers. Me personally, if you put the other, what we were just talking about with the e-invoicing and wanting to bring that together, they're probably starting to condition small businesses to paying earlier and more quickly. So I think this is part of that conditioning process, although I'm very confident that you won't find that written into any document that the ATO releases on why they're doing it. Moving on to the next part of 3.0, there's been a lot of talk about enhancing enforcement and debt collection activity. Again, I'm probably a broken record on this front, but we've certainly over the last 6 months, we have seen a real enhancement in their debt collection activity. They're getting a lot more sophisticated about how they do it and when they do it. And when I talk about that, I'm talking particularly around garnishee notices. They're garnishing a lot more companies now. We're seeing them garnishee directors for unpaid PAYG for expired director penalty notices. So I think last year, the reported numbers are something like 26,000 director penalty notices were issued last year, totaling $4.4 billion in debt. Now, I know that there are a lot of directors who didn't bother dealing with director penalty notices last year. So it's now all sitting on their personal accounts. So while they're still sitting there dealing with the company in whatever form that the ATO is dealing with that, they have the ability to issue a garnishee notice on the director. And they're issuing garnishee notice on the director's wages in the company that they're still attacking. And we've seen that a number of times. Now, again, that has its own problems because directors don't like taking pay cuts and they need to pay the money to the ATO. So if they've got a 20% garnishee, again, we see directors are then taking a 20% extra distribution outside of their wage. And that's putting more pressure on the cash flow of the business because they still need to pay the 20% to the ATO on the way through. So these are just some of the things that we need to that need to be considered. Garnishees, and again, I've mentioned this before, but they're getting very smart by attacking FPOS facilities. They used to only attack bank accounts, and then they found that people would change the FPOS facility to go to a different bank. So now they're actually attacking the FPOS facility to get it earlier. So they've, through their data matching, they seem to be able to find ways to attack the money quicker and earlier. You're also finding that, you'll see, we all know in our own personal tax returns, if you've got money in the bank, at the end of the year, the ATO upload the interest charge straight into your tax return. Well, that's a pretty good flag if there's a good interest amount coming into there and you've got a debt owing personally, the ATO knows what bank account to put a garnishee notice on. Right, so there are a lot of different ways that they're now using their data matching to help attack that sort of thing and to get their hands on that sort of information and then use it to their advantage to get paid. The other thing that we're finding is that with the data matching there, it's actually getting much harder to get payment plans through because they have, and although they can't see into the bank account of an individual company, I don't believe that they've got the access to that at this moment, not fully anyway. But if you're a business in this industry turning over X amount, which you've been reporting to them, and then you ask for a payment plan that says that you're going to pay the amount off over 12 months. Again, some of the conversations coming back are, we're not going to accept this payment plan because we don't believe a business in your industry can actually turn over enough money for you to be able to meet that payment plan. So they're able to do data matching to ensure whether payment plans are realistic and real for the circumstances. I will remind you all, for those of you who are still doing payment plans for your clients, if you're asked to provide bank statements, you're asked to provide balance sheets, profit and losses, accounts receivable, listings, all that sort of stuff, please be careful not to give anything that they can then use to their advantage to collect when they say no. One of the big ones that we see happen is that you'll give a list of the accounts receivable list unredacted. You'll have client number one, who's your biggest client every month, and you bill them $50,000 a month. They will issue a garnishee notice on that client and say, give 20% of everything you give to the company, give it to me first. Well, give me 100% of it. So, but if you redact the names of the accounts receivable, you still leave the detailed accounts receivable in place, but redact the actual client names, then it makes it harder for them to issue a garnishee notice when they say no. And I can tell you they use that strategy regularly, so it's something to be very mindful of. Overall, what I wanted to say about 3.0 is that I think we're, like everything in this world at the moment, technology is dragging us down the path to a lot more synergies. Some of those synergies are going to be very well worthwhile. Some of them are going to might be painful, but they'll be useful. But while we're being dragged down that path, some of them will have some fairly dire consequences for businesses that are in distress. So if you and some of those dire consequences are more about the director personally, and will be about the director personally. So being aware of some of those paths that we're going to head down over the next 3 to 5, 10 years, there may be time to start thinking about some asset protection around your clients now, before some of these issues come to play. As I wrap up, if there are any other questions, please pop them in. The one other thing that I do want to say is, this is going to sound like a sales pitch, but I just really want everyone to be clear that when you're providing advice to your client or you're sending them in the direction of someone, make sure that person has the ability to look at both the director personally as well as the company. Talking directly with IPs, and I don't want anyone to get the wrong impression. Insolvency practitioners are critical to my business and they're critical to the business market, but they have a role, and that role isn't necessarily for the benefit of the director. So please be careful in the advice in where you send them. It costs you nothing to send them to us, and it costs your client nothing to get a report from us on a way forward. We are unfortunately, due to people having much bigger marketing budgets than I do, we're seeing a lot of people going directly at the moment, and the pain of that is actually causing them a lot of grief. So that pretty much wraps me up for this month. As I said, next month we'll be back, and I'm going to go through some of the things that you can look at outside of the normal tax planning that you need to do while you've got your clients in front of you talking about the year ahead. Phil had one more question. What about parallel with DPNs? So, okay, in really simple terms, any company debt that's made a director penalty notice, it's what they call a parallel debt. So the director penalty notice can exist, and let's say the director penalty notice might be for $150,000, because a director penalty notice for GST and PAYG can only be for the core debt. The business can still have a total debt of $300,000. Both of those debts sit on each of the accounts separately, even though they're combined. If I pay the GST debt down, then the company debt will reduce. If I pay the company debt down, the GST bit will reduce. So they are parallel, and while they're both alive, you can pay either account and it'll work. I always recommend pay the DPN debt first via the BPAY debt if you have both, because it reduces at a more complete rate. If you pay it into the company, then it can offset against interest and charges and penalty fees in the company, whereas a DPN debt is only the core debt. So it's something to be mindful of if you are helping a client make payments where they have both in existence. Outside that, I thank you all very much for attending and joining us again this month. It's been nice to be back online. We missed last month because we were doing it in person. Can DPNs be shared amongst directors? Normally, if they issue a DPN, all directors get the same debt parallel. So again, if we talk that 150, all three directors will get director penalty notices for 150. If one director pays all of it, then they all go away for everyone. If one director pays 50 because he thinks it's their share, they're still responsible for the other 100. So you can't just split it and say we're all going to pay one bit unless you all do pay one bit. But if one says I'll pay the 50 and then they pay it, and then the other two don't, then the director who paid the 50 is still liable for the other 100 as well. So again, a really important thing to make sure that you've only got the right people in as directors, because you don't want to add anyone that you don't need to. Outside that, thank you all very much. For those of you who got Anzac Day services tomorrow, because you're either going because you've lost loved ones or have loved ones in the armed forces, or just going there to give your respects, I thank you all on all fronts. I appreciate everything that everyone does in the armed forces, and I think it's an incredible day for us all to reflect and celebrate what are great people and great men and women of the armed forces, both past and present. Outside that, thank you all. Have a great month. For those in Queensland, I know you've got another public holiday coming up in a week and a half. The rest of us actually go back to full working weeks. So have a great long weekend. Thank you all for attending again. And if you have any other questions, please feel free to pick up the phone and call myself, Hank, or any of our strategist team at any time. We'd love to talk to you. Thank you.